This is LONGWave, featuring technical analysis and market analytics by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on his analysis, which he feels to be accurate and unbiased. Participants may or may not hold positions in any securities that are discussed. You should always consult a registered investment advisor before making any investment decisions. Now, let's join Gordon for today's show.
Good morning. It's Tuesday, May the 6th, 2014. I'm Gord Long at GordonTLong.com. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscriber reports so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term, risk, and in the short term, confidence and sentiment. In this regard, I'd like to distill this month's audio down to a brief recap of these three areas in the context of what I see to be the unprecedented mispricing of risk and the credit cracks that will, as a consequence, appear when this happens, and they are appearing. They are not great short-term market timing devices, but they are critical to being prepared for important moves in the markets. I'd like to discuss, therefore, mispriced risk, credit cracks, and something that I value, the Copec LONGWave. The bottom line to me is that I see volatility increasing over the next 60 days, between now and the June quadruple witch, with a major market correction beginning by July options expiration and lasting into the fall. We have talked extensively within the Global Macro Tipping Point Service over the last few years of the specific moral hazard and unintended consequences that has emerged as a result of what I refer to personally as monetary malpractice. This is not to suggest that it is driven by incompetence, but rather it is part of an orchestrated plan to ensure government debt financing continues despite the magnitude it has grown to. The most important role of all for central banks, but seldom mentioned, is to make sure that government spending is funded. When taxes, which include all forms and levels of taxes, licenses, fees, penalties, etc., and then stealth tax of inflation, both run out of room, democratic governments are forced to resort to the macroprudential strategy of financial repression, which we discussed in this month's GMTP under the lens audio. The cornerstone of financial repression is sustained negative real interest rates. As such, the Federal Reserve has steadily orchestrated a continuous and highly controlled, as you can see how tightly the 10-year U.S. Treasury channel declines as shown here, to reduce nominal interest rates and the consequences of reduced financing costs for government debt financing. If we were paying interest rates we had only a few years ago, the U.S. government and most developed economies would be in the midst of an even worse financial and currency crisis. The point here is that this sort of manipulation does not come free, as has been most evidently witnessed by the serial bubbles that we have experienced over at least the last 2 decades. When we look at factors such as margin debt levels, it is blatantly obvious we are once again at levels that have proven in the past not to be kind to the equity markets. Actually, we are at levels we have never experienced since the U.S. came off the gold standard. No doubt you are familiar with the emotional euphoric cycle which the equity markets go through, an example of which is shown here on the left. What you may not be as familiar with is that the credit markets go through a similar cycle despite it being more analytic and traditionally more conservative than the equity markets. When you map developments and milestones in the credit markets, you immediately see we are at levels that are traditionally considered elevated and excessive. U.S. distressed debt spreads have now reached 5-year highs. We are quickly reaching levels that we witnessed prior to the 2008 financial crisis, and when you look at the details, appear to be accelerating. Though this is a U.S. chart, I would be amiss if I didn't tell you that China's is even more dramatic when you consider non-performing loans that are going actually through the roof. There are various kinds of loans, such as PIK loans, which is short for payment in kind, covenant light loans, and others that are good indicators of the risk being taken by lenders and borrowers assuming higher levels of leveraged risk. As you can see, they are also at extremes. I have mentioned previously in some of my writings of a Bloomberg proprietary credit analysis, which involves a regression analysis of a number of key credit metrics. I refer you to Pay Attention to Credit Markets article for more detail. I've been finding it extremely accurate if analyzed properly. It is presently signaling a significant 70-point S&P 500 divergence. If credit weakens further, which I expect, this divergence could worsen. Certainly it says caution is advised near term, and volatility may soon be the order of the day. I'm also seeing signs of a potential bond rotation and potentially major portfolio rebalancing moves from equity positions to treasuries. As big as the U.S. deficit is, it must be remembered it is being brought down from well over $1 trillion annually to the $600 to $700 billion level. This means shrinking near-term supply. When you couple it with the actions of the Fed to dominate the buying of U.S. treasuries, there is a potential supply shortage coming that any sort of fear trade would ignite. This is precisely what the engineers of financial repression would consider a home run and would map perfectly to that long-term treasury chart I showed earlier. In a recent article entitled Consumer Credit Cracks, the New Shadow Banking Collateral Problem, I also showed the emerging cracks in the U.S. consumer lending details and practices. Whether we're talking HELOC delinquencies, which stands for Home Equity Lines of Credit, non-performing student loan levels, car loan subprime lending and leasing levels, home mortgage credit scores, housing down payment required, shipping credit, etc., there is mounting evidence of serious decay in credit. The problem is that most of this credit is funded through the shadow banking intermediation channel, a process built on borrowing short and lending long with significant duration risk exposures if credit was to tighten abruptly due to fear, for whatever reason. During the financial crisis, it was the asset-backed commercial paper problem. Today, the acronyms have changed, but the exposure is the same when we delve into the world of repos and collateral transformations. Dodd-Frank has done almost nothing to fix this systemic hotspot. Another article I recently wrote entitled Risk is Leaving the Market, I showed the cascading nature of risk leaving the market. By that I mean how the higher risk stocks are weakening ahead of what is considered the less risky stocks. This is normal and classic during a market topping process. It may not be a long-term top, but it is likely minimally an intermediate-term top that we are looking at. The large players are leaving as the public begins feeling confident enough to re-enter. As usual, it is the fear of missing out that attracts them when the risk is at the highest. An indicator I like for situations like this is the Russell 2000 to the Russell 1000 ratio. As risk leaves and risk off begins to take hold, the ratio will fall, which it has. You then pay attention to the moving average crosses for confirmation of an actual trend reversal. We see here this is also happening, though the oscillators suggest it may be a little overdone short term. As I said earlier, credit is not a great market timing device, but it does do a great job of keeping you out of trouble at critical times. I'd like to shift gears slightly and talk about the credit from the big picture perspective. F. Wiley published at the Cynicomics blog 3 interesting charts. The first chart shows the percentage of total borrowing that's funded by the 3 riskiest sources of funds. 3 periods stand out for an unusually high percentage of risky borrowing. The first 2 coincide with the creeping inflation of the 1960s and great inflation of the 1970s. The third overlaps the serial bubbles of the last 2 decades and leads into the 2008 financial crisis. Problems with either inflation or financial instability are exactly what you would expect when debt funding is tilted heavily towards risky sources. This chart divides risky borrowing by GDP. This chart can help you gauge how hard the economy might fall after inevitable cracks appear in credit markets. Not surprisingly, it shows that the 3 periods with the greatest amounts of risky borrowing were followed by the 3 hardest falls: severe recessions in 1973-75, 1980-82, and 2008-2009. Virtually every recession follows a drop in risky borrowing. Large amounts of risky borrowing eventually lead to vicious circles in which soured loans and slower borrowing pace drags economic activity lower. Then you should expect recessions to occur after risky borrowing peaks. This is exactly what we see. The third indicator measures the change in risky borrowing using a 2-year change. It helps to narrow down recession probabilities, and while it doesn't offer ironclad proof that borrowing in excess of non-money savings leads to recessions, there's actually no such thing. It fits into the very process described by economists who've dared suggest that borrowing is risky. These charts ring hard when we consider this next chart. Companies are reporting revenue problems, though they are still able to maintain the bottom line through labor cost cuts, financial engineering, low interest rates, and stock buybacks, as well as dividends to keep stock prices up. But for how long? And as far as I'm concerned, it's extended much longer than I had originally thought. A recession scare is therefore not out of line from a historical perspective. My work with Richard Duncan says that there is a liquidity problem coming in the second half if the taper program is maintained. I personally expect by Q4 the Fed will be forced to insert liquidity or face a potential recession. The markets will react to all of this in advance and with fear from very elevated levels. My macro analytics co-host Charles Hugh Smith recently posted this chart. I've long prized the COPEC measure in the bond market, so I found the analysis interesting. This chart shows the COPEC curve for the S&P 500 overlaid against previous deflationary secular bear markets in the late 1800s, the U.S. market in the 1920s, 30s, and the Japanese Nikkei stock market index from 86 to the present. Charles added notes to the chart to mark the potential market bottoms in early 2015 and a possible peak in the fall of 2016. He also added a note that suggests the shallow troughs in 2005 and 11 were the result of unprecedented financial engineering by central banks. He suggests that the financial authorities have been dead set on limiting market declines and buying time so the broken parasitic financial system could feed off the real economy long enough to restore its viability. It fits with our expectations of an intermediate correction, consolidation, a real deflation into the fall elections, and then rise to new highs in the first half of 2015. Charles's COPEC curve suggests this could last longer and go higher than my current forecast for a final hyperinflation wave. Of course, we still have another year to analyze that part of it. As I lay out in Be Patient, Wait for the Death Crosses, the key here is to anticipate, but wait on confirmations. I expect major liquidity injections from the ECB by June and the Bank of Japan in probably Q3. These will be market movers, as will Ukraine events and a potential U.S. dollar damaging energy deal between Russia and China. Volatility is what it all says. Our strategic macro investment insights this month says to watch retail, commercial, real estate. Falling real disposable income is taking a toll on select U.S. retailers, U.S. retail commercial real estate, and their associated REITs and consumer durables. In closing, I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2014 turn out to be an outstanding investment year for you. Thank you for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.